Welcome to The Edge, everyone. And today we are talking about ETFs. So, what if I told you the NGX is up by 60%, the S&P has gained about 13% year to date, but there are some ETFs that have delivered returns of several hundred percent. Most investors spend their time chasing individual stocks, searching for the next Nvidia, Tesla, GT Co, Seplat. Yet many of the biggest winners in the global market this year haven't been individual stocks at all. They've been ETFs. Okay, so today we would explain what ETFs are, who should be investing in them, and we would examine some of the best performing ETFs in the United States, in Nigeria, and we will look at the factors driving their performance, whether those gains are sustainable. We'll look at the risk factors you also need to understand, and we will share a few ETFs that we believe deserve attention for the rest of 2026. Welcome, everyone. I'm delighted to be joined by Dipo Ajayi. Dipo Ajayi is head fixed income and vice president at Chapel Hill Denham. Dipo, welcome to the Edge.
Yeah, good day, Dr. Capo. Thank you very much for having me on the edge today.
All right, it's a pleasure always having you, and welcome everyone to the Edge. Please like this video, and if you are new to this channel, please like, subscribe, and hit the notification bell. We're here every weekend helping you make sense of the investment world. Okay, right, let's get into it deeper. So our focus today is actually to discuss about ETFs. So what are ETFs and who should invest in ETFs? And are there individuals or professionals you think should not invest in ETFs?
Well, ETF is basically exchange traded fund. They are a type of pooled investment, and but they are just like a mutual fund, but they actually have focus. They are either focus tracking a particular industry or particular index, a particular sector, or a particular asset class. And the good thing about exchange traded fund is that for mutual fund are not exchange traded. They are managed by portfolio manager, but never exchange traded. Unlike mutual fund, ETFs, you can actually get to actually sell in the market the way you sell your stocks in the market, and that's one the edge that ETFs have over the normal mutual funds. And also, ETFs is like you buying a basket of fruits rather than you having to buy just a fruit. And you can decide to buy a mango, but buying ETFs means that you are buying the whole basket of fruits, which include the carrot, the mango, the apple, and a whole lot of other. And just like the way it sounded, you can. I'm sure most of the earth guys in would have they've told us many of those things that some of these fruits are due to our body.
You're making me
What's
think
the
about smoothie.
yeah, yeah, exactly. So like a mango, you can actually get a particular benefit from mango. But when you have mango, you have apple, you have carrots, you have many other fruits in that basket. So it means that the benefits you will enjoy transcend the benefits of just having just one particular fruit. And that's what ETFs is. ETFs is a situation whereby I'm buying a basket of instruments rather than just buying one instrument. So the advantage I have is the diversification. Imagine you buying an ETF that is actually tracking the banking sector. So what it means that I'm buying the whole of that banking sector. So which
Yes.
let me take for example, let's say in Nigeria. So it means that Whatever I'm buying includes GT, Zenith, Access Bank, Fidelity, Wema, and all that. Rather than just going into the market and buying just one particular instrument. And mostly for people that don't have a sound understanding of the market, the best place to actually play is for them to play on ETFs because what that means to them is that it helps them to actually balance their portfolio. It helps them to actually balance their risk, and that's one of the best thing that I think ETFs is actually bringing to the table.
So you would say that ETF is probably for beginners or investors who don't want to do the the difficult task of researching individual stocks. So they prefer to invest in an ETF that covers maybe a particular sector, or that even there are some ETFs that cover, for instance, there are ETFs that cover the entire S&P 500. So which means if you invest in that ETF, you own all the companies within that S&P 500, or you invest in an ETF that covers the NGX. That means you own all the stocks in that ETF. And as Deepo said, it helps you to ensure that you have that broad coverage and diversification on the index. So are there, so you mentioned that if mostly for beginners, what about professionals? Or are there um, some investor types that you think ETFs might not work for?
Well, I think ECF work for all level of investors, both
Okay.
from the beginner to the professional.
Okay.
And there's something in investment, there's something we call the core and the satellite. And the core, you use that to actually layer your portfolio. The satellite is you use that to actually generate better alpha. And sometimes when you want to actually reduce or minimize the risk of your portfolio, you tend to actually step down the risk by actually putting an element of ETFs on your portfolio because that will help you reduce the overall risk of the portfolio. Then, as a professional, then you can now use a particular instrument to actually further step up in terms of the improve the alpha. So I want to give you an instance. Let's assume you are playing in the banking sector and you are
Yeah.
buying ETFs that cover Nigeria banking sector. So you already have that in your portfolio. Then you can now buy names like GT, Zenith to actually further amplify your return. You understand? Rather than just buying GT and Zenith only, having other names. What I would do is to help you minimize the risk and also at the same time improve the level of return that you can actually get from actually structuring that level of portfolio. So for both beginner and professional, ETS is actually very essential. Like we have actually meant, like I mentioned while I was talking about the analogy of fruit. Whether
Hmm.
you take mango for a beginner, whether you are a beginner or you're a professional, everyone would like to actually take a smoothie rather than just having a mango.
Right. Okay. So let's talk broadly now. So the US ETF market has been or has seen extreme dispersion. So we've seen highs with energy commodity linked funds delivering triple or sometimes even quadruple digit return so far this year in some cases, while broad indexes like S&P 500, as I mentioned, provided or produced a modest, maybe like 13% return year to date. In Nigeria, local NGS linked ETFs, I think, have posted strong gains as well amid the naira volatility, inflation, the moderation hopes, and even some sector specific resilience issues that we've seen. But how do you see the overall ETF landscape diverging, or is it converging now between the two markets this year? I'm looking broadly now, looking at Nigeria market and the US market. And are there forces, maybe oil, geopolitical tension, US policy shifts, Nigerian reforms, or the global market commodity cycles that you think are shaping the movement or the growth or in ETFs in both markets this year?
Well, if you look at it critically, you will understand that there's a lot of factors actually underpinning the level of return that we are actually seeing in some of these ETFs. And we mentioned Nigeria, and we spoke about the Stanbic bank ETFs. What it does is that you actually mimic, you actually track the banking names in Nigeria. And if you have looked at the level of returns that we have seen in most of the Nigeria banking names this year, of course, it has been very, very hard. You look at how Zenith has traded, you look at how GT has traded, you look at how Wema has traded, and a couple of other names like that. So it gives you an idea of the level of return that some of these names would have actually enjoyed. And don't forget that when you're looking at NGX, you are looking at the whole broad market. But when you're looking like an ETF, you are looking, most especially when it's tracking the sector, you are looking at the level of return of that particular sector. You could have seen that maybe the banking sector, if it's only the banking sector that is on NGS, maybe this year, and the NGM might have done far better than the 60% that we are talking about. But because it's actually broad market based, so maybe one way or the other, what's happening in the consumer names could have actually one way or the other watered down the level of return. Maybe what's happening in the insurance sector could have one way or the other watered down the level of return. But when you're talking about ETFs, it's concentrated on that particular sector. And and that's one of the reasons why you tend to see more like a better return on some of these ETFs when you compare them with what is happening in the old broad market. And for example, you see what is happening in the United States. We have seen the level of AI development in the United States. There are some ETFs that what they do is robotic and AI and artificial intelligence. You have the ARKQ. The focus is to monitor the company that plays in the robotic and the artificial intelligence sector. And and if you look at what has happened between last year and this year, that sector has actually shown that level of great performance because of the level of development innovations that we are seeing currently globally. We'll see what the AI can do. We have seen what the AI can do more than what we have actually thought it can do. And the only thing that keeps you operating in that space is continuous innovation. And we keep seeing most of these companies actually budgeting huge capital to continue on their research and development stage around developing some more innovations and bringing more innovations to the table. And these are some of these things that investors are actually seeing. And that's one of the reasons why the people keep actually pushing funds into that sector. So there is a particular sector that is monitoring that. So whatever the level of performance of that sector is what you enjoy as an investor in that sector. And there are a couple of players in that sector. One thing that ETF would do to you, that instead of you putting your money in just one company, it helps you spread the risk across the industry. You could have actually put your money in company X, and maybe at the end of the day, company X may ended up going south. Maybe because of the fact that, maybe they actually pushed out an innovation that actually failed. But why company XY and YX is actually performing very well? But when you are on an ETF, what it's doing is that you have company X, you have company Y, you have company Z. So it means that even if company X is tanking, the performance of company Y and Z can actually
we'll be
help
able
to
to
actually hold,
sustain it.
you understand, sustain that level of the. And
Return.
that's some of the things we are seeing generally in the ETFs market. And for me, I think there's still a lot of headroom in that market, and because it's not concentrated in a particular sector. You saw ETF that is actually talking about semiconductors, and these are some of the things that you use for phones, you use for many things, for chips, and some of things like that. You have the SOXL that actually track that particular sector. You understand? You see sector like the ARKK. That one, what it tracks is the space and defense. We see what is been happening in Iran and Iran between Iran and US. We understand that what happened between Iraq We know how the level of attack that Iran pushed on the other brothers in the Middle East. I remember how most times we heard that, oh, there was a missile that was shot to maybe Dubai, but they were able to stop it with a drone or something like that. These are some of innovations that's actually playing in that space. And if you look at that sector it has really thrived this year. And I think on the backs of what we are seeing, and it is not only because of what is happening. Don't forget that because of what has happened, a lot of countries will now want to start actually putting their house in order to ensure that they protect themselves by actually produce some of these things. And increasing production of some of these things means that the company, you have to patronize those companies that are in charge. Patronizing those companies means that you will improve their top line and bottom line. And at the end of the day, if you are seated in those ETFs, it means that we're part of those people that will benefit from it.
Well said, and well said, Deepak. Obviously, the importance of having your funds in an ETF is for that diversification. It provides you access to many of these names that ordinarily you may not have even thought about them. And so it gives you that broad coverage. And so when Adipo is talking about some ETFs tracking some of these names. Obviously, because those ETFs have investments in those names, and as those names continue to thrive, especially in the defense, AI, energy that he talked about, then you can begin to see that also positively influence those ETFs, and we can continue to see the amount of returns the returns that the ETFs would then churn out. But Debo, let's talk more now about, let's focus on US ETFs. And I think you started providing some names. Are there some specific or major US ETFs that you really want to talk about?
Well, Dr. Tony, I think there are a lot. If we had to start talking about some of these, we may not leave here
Yeah, I
today.
know, but maybe some
But
major ones,
but I
like
think
maybe three,
for
four,
me to talk
five that
about
you
some
want to talk
major,
about.
I will look at the XOP.
Yeah.
XOP is an ETF that tracks the oil and gas producers. So it
Okay.
means that portfolio manager, what they do is that they buy names of oil and gas producers into that fund. So it means that you have stocks of Chevron, you have Total, you have the big player, the Shell of the world, you have so it means that as you are continuing to enjoy this level of return, because what is happening in the Middle East, of course, that level of return will also accrue to you in the same manner as an investor. And I think that's one I like. And I mean, I like till date because I think in no time there could be a bit of shifts in that side. And why did I say that there could be a bit of shift? Currently, we have seen the oil price retracing a bit downward on the back of sounding as if there's every likelihood that we may come to the end of this crisis very soon. And so it simply means that the level of revenue that most of these oil players are actually generating as a result of the crisis happening in the Middle East may not be as high as what it used to be from
Yeah.
the beginning of the year. I mean, sometime in February till today. So we may likely see a bit of retracement in price, but maybe not so quickly to where we were before that crisis, because don't forget that most zones, they almost utilize their reserve. The Eurozone, they've almost utilized their reserve. And a lot of them, what they would do is to actually first stock back their reserve so as to actually ensure that in case anything happens in the future, they also can actually resort to that reserve for safety. But when you look at it in the medium to long term, there's every tendency we can see that oil price will tank. And if that happens, it simply means that you may not get that full benefit. And that's one of the reasons why I want to talk about. That's why I want to talk about that XOP ETFs. Another thing is that I want to talk about is the REMX, that is REMX. And what does that actually,
REMX. Okay.
what that measures? What does it track? It tracks rare earth mineral. And I tell you, that is where anybody has to be any day, anytime. Where the world is going to, there's a lot of rare earth mineral that's under the earth. And we keep developing, we keep getting more as a result of innovation. We keep actually getting more benefits from some of these rare earth minerals. We've seen that most of them are
They are used in
in
making
high
those
demand.
chips and all that,
Uh,
right?
yeah. You see some like you want to do for EV cars now, the car batteries. Most of them are from rare minerals. That's where you get most of those. That's where you actually produce most of those things from. So the benefit is now actually tremendous and is actually very big, and it's not short term. And that's why I said that's where we need to be anytime. It's going to be a long time. It's going to be for a long journey. Because as we continue to see more innovation, we'll continue to see the need for most of these rare earth mineral. And if you are seated in it already, it means that as most of these companies keep developing, researching and developing more new products, new output, and some of these things, you continue to benefit because of you already seated in an ETF that's already tracking this particular sector. So I feel that that's a sector that anyone should not actually take their eyes off. And another last one I will talk about is the ARKQ. And that is the one that actually, the robotic and the AI that I mentioned. Uh, the world is about AI as we speak currently.
Yeah.
And I don't think that AI has come to go. I think it has come to stay because what the world is doing to actually improve how best you can utilize AI. You understand? It's not how to take AI out of the world. It's how best we can utilize AI. The danger of utilizing AI. How can we mitigate some of the dangers? And that's what the global world is looking at. And when you look at ETFs that track this sector, they know what level of innovations that most of the company playing in this industry
Yeah.
are actually doing. And you understand? So at the end of the day, when you get new innovations, you understand the benefit will also accrue to you because you are an investor in that sector. Because one way or the other, through your ETFs that is actually tracking this particular sector, you also have been able to actually benefit from this. So there are a couple of other names like that. So what you just need to do as an investor, look at which sector do you think looks like the in thing currently. We've
Yeah.
talked
That
about
is
the oil and
focusing on
gas.
like major
You
trends.
understand? Exactly. When you look at what's happening in that trend, capitalize on that trend by investing in an ETF that is tracking that particular sector. Because when you invest in an ETF, it's better than investing in a company. Because if the company goes down, if you're invested in an ETF, the ETF will be monitoring, tracking more than one company in that sector.
Yeah, okay. So, I mean, still sticking with the US ETF, I really, one that has really caught my attention, in the energy and tanker shipping business, have absolutely dominated the US ETF performance that, based on what I've seen so far in 2026. There's this breakwave tanker shipping ETF, that's BWET, that's the ticker. That ETF has delivered extraordinary return from anywhere between 700 to 1,300% year to date. Okay. Because of the volatility and, because of the tension, geopolitical tension in the Middle East, because this ETF tracks tanker freight rates and oil, energy, um, shipping and transportation. You also have they are linked to funds like the USO, and then we also have the BNO as well. That is also roughly up by about 100% year to date. So these are different ETFs in the energy and the tanker shipping business. So I'm trying to understand what's story behind this outperformance that, and how sustainable you think these ones will be, especially the energy and tanker um, focus ETFs. How sustainable do you think this momentum will be for the rest of 2026?
I think if I'm investing in that particular ETF,
Yeah,
I would actually be very sensitive to what is happening in the Middle East. One of the reasons why we've seen that level of return is because of the crisis, and you understand what is happening on the Strait of Hormuz. Most oil tankers are finding it very difficult to actually pass through that zone. At a point in time, it was a zone where your tanker could be hit by the warring parties. And it means that if I have to take a risk to that zone, then I must be compensated very well for taking such risk. And that's one of the reasons why we've seen that level of performance from that ETFs. And why I said I would be a bit careful was because it's highly correlated to what is happening in the Middle East. So it immediately means that immediately we see
a
sanity return
resolution.
to that zone. There's every tendency that particular ETFs will actually reverse a bit downward, and that's on the back of the fact that there won't be need for them to actually charge outrageous prices for actually conveying most of these products. And also, don't forget that the product they are also tracking is more like oil and gas. And we've spoken around what the XOP is doing in that regard. That he also track what's happening in the oil and gas ETFs. And so it means that if you are an investor in that sector, you are benefiting from the crisis because of the elevated prices that we are seeing on the back of the tension, geopolitical tension in the Middle East. So I think that it is not a long-term benefit. That is my view. It means that by September, I will still be surprised if we are seeing this aggressive level of return in this ETF. Because for me, I think by September we expect everything to have been fully resolved. And if everything has been fully resolved, it means that sanity would have returned to Strait of Hormuz. It also means that we will not see a lot of tankers actually plying that road. It means that we will not see there will be safety. There won't be need for that charging that high level of
Yeah,
cost of
freight
transporting most of
charges.
these products. So I think if I'm an investor in that ticker, what I would do is that I will actually monitor what's happening in that zone, and immediately I sense any clarity, I might actually need to actually divest from that particular ETF to a better one.
Okay. I mean, beyond the energy and tanker shipping boom that we just talked about, you also already started talking about some of these AI related stocks like SMH, SOXL, SOXX.
Mm.
Some of them have continued to post significant gains, at least year to date. But the concern or my question is, are there like macroeconomic factors like interest rate expectations, inflation rates that you think is separating these high performing ETFs from others? Because to be fair, not all ETFs are pumping, at least so far this year.
Well, I think it's a function of what is happening in each of those industries. And imagine an ETF that is tracking consumer industries.
Yeah,
And don't forget that currently um, the capacity to actually consume on the part of an average citizen has
yeah,
actually dropped on the back of increased inflation, increase in prices of things, and the like. So one way or the other, the end result is that people may likely consume less, and because of the purchasing power. So it means that I may not be able to buy as much I used to buy. And so if you are not buying as much as you used to buy, it means that in terms of volume, most of the consumer name may not be actually posting that same level of volume that they have posted in the past, or maybe an even improved volume. I mean, when I'm talking about volume, I mean sales volume. You understand me? So imagine an ETF that is tracking that industry. This is not a very good time for such ETFs, and that's one of the reasons why you will see that the interest of investor will not be in that kind of ETFs, because you are not part of the names that's currently benefiting from the happening around. And now we've spoke around what's happening on SOX. We've talked about what's happening on SOX as well, which is more like some of the things in high demand. And don't forget, market is basically demand and supply. So when demand is outweighing supply, of course, it gives you an idea of where you need to actually put your fund at any particular point in time.
Yeah.
And I think these are some of the things. So what is affecting the others is more like what you have mentioned, the macroeconomic factors, inflationary pressure, interest rates, and other growth, and some of other things that is macro in nature. And what we are doing, that's actually dampen more like growth for some of those companies. And when you are not seeing any aggressive growth in sight, of course, the best way is to actually look for a better names that will actually give you that level of return. And that's why you are seeing that influx of funds into most of these thriving ETFs. So for me, I think this would not be a very good time for me to want to put my money in ETF that actually track consumer names. You understand me? I would rather want to put my funds in the robotic AI. And even the banking sector will not be a bad place to actually put your money, because whether it's
Yeah.
up, whether it's down, they are always benefiting from the market. They can always pass in the cost to their customers in one way or the other. So I think just like I agree with you that macro factors are some of the things that could actually differentiate the performing ETFs from the other. Because if you are not performing as a result of negative macros that's currently hovering around the world, of course, that will actually affect the level of exposure that you have to most portfolio managers that are tracking ETFs.
Okay, so quickly, Deeper, before we talk about some standard ETFs in Nigeria, are there 2 or 3 US ETFs that you think investors need to watch for the rest of 2026? And if there are, why? And what due diligence is essential given the volatility we've seen in some ETFs?
Well, for me, on my number one on my list would be the SOX, SOXL, and because of the semiconductor, the AI chip boom that currently still enjoying globally. And for me, it's not something that will end within the next 6 months. You understand me? So it's something that will continue for a bit of time. And if that continues, it simply means that there's no other place for you to be now than in such name. I spoke around the rare earth mineral, and that
Mhm.
is the REMS, that is REMX. And I mentioned that that's what it does is that the rare earth mineral, like uraniums, like for producing some of these, what is this product again that you use to actually produce batteries now that we use
Lithium.
lithiums, and a whole lot of that, the zinc, the copper, there are many other rare earth minerals that you have around that you can actually capitalize on. You understand? And these are some of them that also monitor some of these commodities as well. So it helps you to actually benefit from where the world is traveling, because the world is moving into an era where the world is talking about clean energy. The world is shouting about clean energy. So where else would you be if not something that has lithium? Because globally, lithium is assumed to be something that can actually help you produce output with a clean energy, you understand, which
Okay.
globally we believe is better than oil and gas. So if we are moving from more like a world that is more currently polluted to unpolluted environment, of course, you'll be talking about lithium. So it means that if you want your money, then you have to track some names in that sector as well. And also, I think you can also leverage DRAM, that is talking about the memory chips companies. And they currently one of the fastest growing ETFs in the United States. They are tied to AI data center demand. And you imagine you and I know what we do on clouds. We know what we do on Chat GPT. You know what we do on some of these things. And don't forget that when you actually buy into some of these things, whatever cost you are paying to actually get access to this some of these facilities as well, it means that at the back end you're
You are
also
getting them in
enjoying.
return.
You understand? You're also getting benefit in that regard. And to be realistic, I don't think they will leave anytime soon. Because one way or the other, they have one way or the other improve the productivity of business owner, the productivity of people. You understand? Because what you used to do that takes you an hour to do, you can do it within 5 minutes and you're done. So it means that it saves you time. You are able to use your time for many other things. And so when you look at these three, for me, I think it cuts across different sectors, and that's one of the things I actually. And for the oil and gas, one of the reasons why I'm actually drawing back on oil and gas is because I think the current gain will maybe actually short-lived because of the fact that there's trying to be more like a resolution in that
Okay.
crisis. Yeah.
Okay, so I mean that's there are a whole lot of ETFs out there. What you need to do is to do your due diligence, understand the underlying assets, tracking those ETFs, and then you'll be able to make an informed decision. Okay, it's always important to stress that with every investment comes its own risk. So it's important that you do your due diligence before making investment. So, Deepo, let's quickly talk about ETFs in Nigeria. Are there some major ETFs in Nigeria that stand out that you like to talk about?
Well, for Nigeria, there are a couple of names in Nigeria, but I'll just mention a few. There's the Lotu Alal Equity ETFs, and
Mhm.
the reason why I'm speaking about is Sharia compliance. It means that whatever is in that under that ETFs, it means that it falls within Sharia compliant instruments. We
Mhm.
have some investors that are very careful in selecting names. They don't want to buy names that will actually contradict their faith. So
Mhm.
people like this, it's easier for you to actually play on the safe side by actually just investing in the Lotul Alal Equity ETF. And it's actually a very big ETFs, and it's also very performing very well. He has actually reported one of the highest yield when you compare it with other ETFs in Nigeria.
What's the return? What's the
I
return like?
think as of last year, he did about 64 percent last year. That's far above what the whole market did
Okay.
last year. And we have many other names. There's the new gold ETFs. The new gold ETFs have exposure to physical gold. And the good thing about new gold ETFs is that it's dual listed. It's listed in Nigeria, it's listed in Johannesburg. So it means that you can actually trade the same name on both exchange. And I think I've mentioned on this program before that at a point in time, you more like the exit route for most investors,
Yeah,
foreign
what to
portfolio
invest
investors
in gold
during
ETFs. Yeah.
the capital control era. And so he actually exposed that to fiscal gold. And you and I know that in such an environment where there is uncertainty, it simply means that there's no other place to be in commodity. And when you're talking about commodity, first thing that comes to the mind is gold. You've seen the level of return that was anyone investing in gold would have actually enjoyed this year alone. So it means that investing in these ETFs, you have been able to actually have exposure to gold. And the last one I'll talk about is the Stanbic IBTC ETF 30. And what he focused on is NGS 30 large cap stocks. He only focused on large cap stock. And don't forget that the good part of actually focusing on large cap stock is the high liquidity and popularity that you enjoy. And so when you look at names in Nigeria, when you're talking about a large cap stock, you'll be talking about names like Dangote Cement. You'll be talking about names like Aradel. You'll be talking at names like
MTN.
MTN. You understand? So imagine you having this level of giants in your portfolio. It means that most of the return that most of these giants are actually posting, you're also enjoying part of it. And I think another one I would like us to talk, which is very close to the Stanbic IBTC ETF 30, is also the Vertiva Greenfield 30 ETF.
Okay.
You also track, just like the Stanbic large cap 30, same thing. You also track the NGX 30 large cap stocks as well. The exposure is broad market based. It cuts across the whole market, and these are good names that anyone would want to actually put their funds.
But the question or concern would be, so you have some of these ETFs that you mentioned, the Stanbic IBTC ETF, the Vertiva ETFs, tracking just about 30 high liquid stocks on the NGX. So looks to me like they don't provide you an opportunity to benefit from some of the mid cap stocks, because some of the mid cap stocks is where we see most of those volatility and those high returns, if you understand what I mean.
When you look at it critically, it depends on what you want to do. And
Yeah, I
don't
agree
forget
with you. You might be, if
don't
you are
forget that we
interested
said
in some
when I was
moderacy,
talking
yeah.
earlier on, I said something around the core and the satellite form of investment, and
Mm-hmm.
I said that you can actually layer your portfolio with ETF to help you
Mm.
minimize the risk, and also use maybe like a mid cap stock or the small cap stock to actually amplify your return. And so, when you are going into a mid cap stock or a small cap stock, you are taking huge level of risk because they are not as liquid as most of these large cap stock, and they are actually sometimes very volatile as well. So you can actually use something like this to actually help moderate the risk that you are taking in that segment of the market.
Yeah. So how would you compare the performance of the ETFs in Nigeria this year to the NGX?
Well, the performance of ETS in it's always better because we have said this earlier on that it tends to when you're looking at the whole market base, you see the ups and downs, you see the good, the bad, and the ugly, and you understand me. But when you look at some of the ETFs, it's tracking a particular names, it's tracking a particular sector. And in as much that that sector is thriving, there's every tendency that will outperform what the whole broad market is doing. And it's not peculiar to Nigeria. We just mentioned the United States.
Yeah.
You see what the S&P 500 is doing compared to with what like a SOX would have done this year. You understand? You found out that they are miles apart because when you actually do more cover more ground, there's every tendency that you will have some names that will actually minimize your level of return.
So these different ETFs, the Stanbic, Vertiva, Lotus, are you are these ETFs are they do they help investor manage their diversification if
E-
they focus on just
Exactly.
if they focus on just
Exactly.
specific names? Those
Exactly. They
are they broad like the Stanbic 30 ETF? Is it broad market based or just focus on like banking sector?
No, no. When you look at the Vertical Griffin 30 ETFs, it's
Hmm.
actually broad market based. You look
Okay.
at the Stanbic ETFs, it's broad market based, and that's why. You remember when we were giving an example, we mentioned NTN, Dangote Cement, we mentioned Aradel, and if you look at it, MTN is playing in the cement sector, MTN in the telecommunication sector, Aradel in the oil and gas sector. So it means that you are able to actually have exposure across all these sectors and also benefit from the level of return that some of these giants are actually posting in the market.
All right. Dipo, I think we need to talk about the risk involved in investing in ETF. When I evaluate an ETF, for instance, I ask myself some questions. I say, what does it own? That is, what are the names within that ETF? Why is it performing well? Okay. Um, what risk could derail it? We already talked about the energy focus ETFs, for
Mhm.
instance, if energy prices come down. So I try to ask myself what risk could derail it? What are the fees, for instance, that I need to pay to maintain that ETF? And does it fit my overall portfolio? If I can't answer those questions, I don't invest. Are there other, I mean, I don't know what you think about this, my framework for evaluating the ETFs that I invest in. Are there other risks that you kind of monitor when you are making decision on ETFs to invest in?
Well, I think you have actually mentioned a couple of others then, and we look at the market risk, which is actually very essential when you're looking at that. The market is overall market risk. It means that you are looking at the interest rate risk, you are looking at every other liquidity, exchange rate risk, you are looking at every other risk as well. These are some of the things you actually look at. When you are actually you look at the liquidity risk as well and how liquid is that these ETFs is it very liquid in the market? Can I get to actually exit anytime I want to exit? Is this something that when I need liquidity I can quickly get out of the market? And these are some of the things that you need to actually consider beyond what you are actually mentioned. You spoke about the sector as well. You need to look at the sector very well because there are sector specific risk that may not be general. Just like what we are talking about, we talk about the crisis in the Middle East. We spoke so the benefits currently accruing to the oil and gas sector. And
Yeah.
in no time, if this thing is reversed, it means that there's risk that this could be short-lived. And these are some of the things you need to look at as an investor. You need to look at the market. That, for example, if you've actually tracking a sector, I would prefer more like a bottom-top approach in your analysis. You start from the company, you look at the sector before looking at the global economy. Because what that would do is that you would then be able to do very good job on the company. Companies in the ETFs should have been able to look at very well at what is happening in that sector, and you'd have been able to look at what would have been the impact of the policy of the country at that particular point in time on some of these ETFs.
Yeah, and I agree with you. I think for the US ETFs, we need to for an investor, you need to track geopolitical reversals that could happen after the massive runs that we've seen. For the Nigerian market, we need to track inflation and maybe currency. What are the currency depreciation or naira depreciation? That could be a factor. But are there like key risks that one must consider? For instance, if you, I mean, if you are new, I think you already even talked about that, which is, understanding the different names from that bottom up approach that you talked about. So I think normally for me, I think what is critical, you need to check geopolitical reversals if that happens. For instance, on the energy sector, those ETFs tracking energy. For Nigeria, we talked about naira depreciation, and I think naira has been stable for some time. So really, the risk there, I mean, coming from currency side, isn't that significant. But looking ahead for the remainder of 2026 and maybe even beyond, what opportunities do you anticipate? I know you are big on AI. You talked about that since we started the discussion. Will AI or energy dominate the ETF space for the rest of the year and even continue? And in Nigeria, what are some of the reforms that you think could even sustain these ETFs that we've been talking about? I mean, the Nigerian ETFs.
Well, for me, I think my vote goes for AI, and like I mentioned earlier on, there's every tendency that we may likely see reversal for what is happening in the oil and gas space. That one way or the other will actually affect the ETFs tracking these names. At the end of the day, we may likely see the AI actually speed past that and actually post a better performance by the end of the year. So I will actually go with most of these names playing in this sector, and also I mentioned the rare earth mineral guys as well. Those ones, for me, they are long term. They are even longer than the AI for me because the global development and some of these things that we're seeing will continue to rest on some of these rare earth mineral. I think it's a place where I would want to put my money. And when I look at Nigeria, I think when you look at the new gold is in line with what's happening in the Middle East.
Okay.
Because when there's geopolitical tension, a lot of people fly to safety. Flying to safety is two. You either put your money in the greenback, which is more like the USD, and
Mm-hmm.
maybe US dollar assets, or you put your money in commodities like the gold. And we are seeing a huge movement of fund into the gold this year. I think when this crisis actually simmers, there's every tendency that we might actually see investors selling down some of their holding in gold to actually divert into maybe other asset class. What that will see is that we will likely see more like a pullback in the prices of gold in the market. So for a smart and a sharp investors, it simply means that we'll also be tracking what's happening in the Middle East. So immediately I see that there's a likely resolution or there's resolution, what I would quickly do is to actually divest a bit from holding maybe investment in new growth to actually capitalize in other ETFs that can actually give me a better return in that regard. And when I look at other names, there's the Stanbic banking ETFs that actually track the banking sector in Nigeria. I still think that there's still a lot of headroom for most of these banking names. There's a way you think that it seems that it's all done. It seems that they will be unable to actually replicate what they did last year. But when you see their Q1 results, of course, that quickly change your mind around what you think they will be unable to do, because most of these companies, and don't forget that they are recently they just recapitalized, so it simply means that they have more firepower, they have more cash to actually sweat out, and doing that, it means that they have more capacity to generate revenue. And at the end of the day, that will actually affect their bottom line, which will also translate to a better valuation in the market. So I still think that the banking name still brings a lot to the table in this regard. And also, the Stanbic and also the Vertiva ETFs are also a very good place to actually put your money. I mean, the large cap 30. Because what he's doing is tracking 30 most capital stock in the markets. And like we mentioned, we are talking about the big name. And it simply means that by the end of the year, we may be having the Dangote refinery on this list. And Dangote
Okay.
refinery is what most people want to have in their portfolio. So it means that actually investing in some of these ETFs will help you get exposure into some of these names.
All right. Let's begin to coast home. If you were to provide like any advice for building a high conviction Nigeria slash US ETF, if you have like 10 million naira today, how would you allocate the funds into the various ETFs? Would you be looking at like the VOO, VTI, maybe gold equity ETFs, AI or the Vet Bank, Lotus Halal, the Stanbic IBTC? How would you allocate, like if you have 10
So,
million
so
naira and you want to
So,
allocate them?
so the 10 million in question is only for ETFs or for broad market investments.
So let's have, how would you best allocate it? Would you
So,
do
so for
most
me,
ETFs or you would do in addition to like
I
selecting some
will,
specific names?
I will do 40% for ETFs. And
Okay.
don't forget that I said that for me, ETFs is to help me stabilize my portfolio. I'm still very young, so it means that I can
Yeah.
still take
Would
a
you
bit
would
of
you
risk.
would you mention? Can you tell us like the ETFs you've been
Yeah,
interested?
yeah.
Where
So
would you
so
put them?
the 40%, I will take the 40% into 50%. And
Okay.
and that means that 20% in Nigerian markets, and the 20% will be I'll get exposure into the large cap 30. And also I will try and get exposure into the Stanbic banking ETF.
ETF.
And for me, I'm not the Sharia, this thing does not affect it. So I mean, not want to actually push any form into that. I will be purely just stay with my large cap 30, and I will stay with the banking ETFs. And like I mentioned, I won't be an investor in the new gold. Because of the expectation that the price of gold may likely tank after there's clarity and globally. So the other 20%, I've told you my best. I've mentioned AI, the SOX. I
Yeah.
mentioned the REMX, rare earth mineral, and so I'll actually put the remaining 20% into that, and my other 60% can now be used to actually amplify my portfolio. And so I have many names in the market that I can put my money in. And I have names like I mentioned earlier on. There's a lot of opportunity in the market where you can put your fund, banking sector, the non-banking sector, the consumer names, the cements, and the like. So I can now apportion the 60% across this sector. Maybe focusing majorly on the mid cap names, so as to be able to actually enjoy the volatility and the likely return that most of these mid cap names can actually bring to the table. And that's how I'm actually going to allocate my portfolio.
Yeah, that's great. Some of these Nigerian ETFs have actually popped a lot. Like the Lotus Halal, I think is up about 67% this year. The Vetiver fund that you talked about, I'm seeing that it's up about, I think, about 42%. And there are some others up about 148% this year. So we really have seen tremendous growth in Nigerian ETFs this year. So I think we need to draw it to a close. I have one question, one final question from one of our viewers who asked us to explain whether if a bank dilutes or whether share dilution can affect the stock price. I don't know what you have to say about that.
Well, for share dilution, you have to look at it from two sides. It could actually lead to affect the price of stocks in the market. And this premise on the fact that it will lead to reduction in EPS. And if the earning per share actually dropped, there are some investors that look and compare you with what other players are doing in your sector. Let's take, for example, in the banking sector. You see Bank A that just diluted, and maybe the EPS was down by maybe another 20%, and you can get a better EPS elsewhere. Of course, you tend to see investor actually moving into that part. But the flip side of it is the fact that you have to understand what is the reason for the dilution. Sometimes the reason for dilution could be positive. There's some names currently in the market. Okay, let me give you an example. Now, that sugar is currently in the market trying to do the right issue. And the purpose of the right issue is for they are trying to actually improve their backward integration and also to actually reduce their loans. And if you have looked, if you have been able to actually look at their book very well, one of the reasons why Dangote Sugar has been posting losses for some time has been their finance costs. Their finance cost has been very, very high. So now imagine the company looking that let us raise equity so that we can pay down the finance cost. If we can save the finance cost, of course, it means that you will affect our bottom line. You
Yeah.
understand me? If that will affect your bottom line, there's every tendency that you may actually have a better EPS. You understand, even with the dilution than what it used to be. Because if the cost you are saving is more than that the benefit you are losing. And at the end of the day, it will be better. And don't forget that in the long run, it could be good for the company. This year, you may see EPA drop, but when you actually evaluate for maybe in the next 2 3 years, you are looking at that. Oh, the company is using the fund for expansion, and you look at it that expansion will improve output. If output increase, it means that the bottom line will increase. So it means that the available cake that you have to share at the end of the day will be larger than what it used to be. And there's every tendency that investor may have a better share than what they used to have. So you must be able to dissect it to see that this dilution, what is the motive? Uh,
Yeah.
if the motive is right, it means that at the end of the day, the short to medium term, you start seeing the impact on the profit after tax. And if the profit after tax, you have the expectation that profit after tax will grow, of course, I think it's worth taking the risks around.
All right. Thank you so much for your insightful response there. Just so as we close, the ETF market, as we talked about, has produced some extraordinary winners so far in the 5 months of 2026, from the tanker shipping and energy in the United States to global diversification opportunities that we are seeing. And for the Nigerian investors, we've discussed about the numerous or different ETFs or ways to participate in ETF without having to rely on specific stock selection. So for me, and based on what we've discussed, the key isn't you trying to chase the hottest ETF in the market now. That's not the idea of this discussion. It's actually educational purposes. So it's not, the key is not for you to start chasing the hottest ETF. The key is understanding what the ETF owns, why you are going to be owning that ETF, and how it's going to fit into your long-term wealth building strategy. So, if you've enjoyed this discussion, please let us know in the comment section. Would you rather be investing in individual stocks or ETFs? And if you are going to be investing in ETFs, which ETFs have caught your attention so far this year? Please let us know in the comment section. And Deepu, I'd like to thank you so much for joining me today to discuss this wonderful topic. And I hope it's been a blessing to our listeners. And it's always insightful hearing, always thoughtful hearing from you. And thanks for always coming up to share your wealth of knowledge in this space.
Thank you very much, Dr. Okafor. Thank you once again for having me on your show today. It's
All right,
always a pleasure.
yeah, thank you so much. Thank you everyone for joining. Again, please like this video on your way out. And if you are new to this channel, please subscribe to the channel, share with your communities, and let us have any questions that you may have in the comment section. Thank you, and we are out.